Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, Amazon plans big increase in AI spending. Amazon says it expects $200 billion of capital spending in 2026, up from $128 billion last year, and the stock dropped about 10% in after-hours trading. That's not a quarterly nuance, that's a regime signal. This is the Wall Street Journal, and it's describing a moment where the market is suddenly forcing a question that tech executives have tried to dodge for 2 years. What is the return profile on AI CapEx when everyone is building at once? Because spending doesn't scare investors when it's paired with accelerating operating leverage. Spending scares investors when it looks like a tax, a toll you pay to keep your position, an arms race where the best-case scenario is not winning but merely not losing. The page gives you the immediate catalyst. Amazon unveiled plans for a nearly 60% increase in AI-related spending, and it also reported growth in its cloud unit that was slower than rivals. That combination is what makes markets flinch. More spending, slower relative growth. So let's talk about why this matters. And let's talk about it like allocators, not spectators. Amazon is one of the most important capital allocators on Earth. It isn't just a retailer or a cloud company. It's a compounding machine that reinvests at scale. For decades, the bet was simple. Reinvest heavily, build the rails, and eventually the cash flows catch up. But when the company is telling you it will spend $200 billion in 1 year, you're not looking at a normal reinvestment cycle. You're looking at infrastructure sovereign behavior. You're looking at a company acting like a nation-state. And the article explicitly makes that comparison. It says the collective spending planned by Microsoft, Meta Platforms, Google, Amazon, and Oracle, more than $700 billion in 2026, is close to Japan's 2026 spending budget and exceeds those of Germany and Mexico. That's the core frame. AI CapEx is no longer tech spending, it's industrial spending. Now let's identify the central figure. At Amazon, the central figure is the CEO as allocator, Andy Jassy, because this is the kind of decision that sits above product teams. It sits above quarterly guidance. It's a belief about the future of compute demand, the competitive landscape, and the strategic importance of owning the capacity. The central figure is also the market itself, because markets are now trying to price the payback period on data centers and AI-related computing demand. And that's hard, because the payback is not linear. The industry story goes like this. Demand for AI-related computing is surging, so the hyperscalers are scrambling to build and finance data centers. But the investor fear goes like this. Spending on data centers is outpacing growth in revenue. Those are two different curves, and when those curves diverge, the market forces accountability. Now, the inflection point, shareholder response is no longer uniform. The article says shareholders have responded unevenly to spending increases. They've rewarded Meta and Google due to positive improvements in advertising and other businesses, and punished Microsoft and Amazon for not increasing their AI-related businesses quickly enough. Read that again. They're punishing some companies for spending too much, and also punishing them for not growing the AI-related business fast enough. That is the trap of the transition period. During a platform shift, the market wants two contradictory things at the same time. Invest heavily, but also show near-term proof of monetization. Build capacity, but also show pricing power. Expand CapEx, but also expand margins. And when you can't do both, your stock becomes the battlefield, where everyone argues about what matters most. Now let's do the capital allocation/decision autopsy. Decision 1, raise $22,000. What was expected? If AI demand is real and durable, if enterprise adoption keeps rising, if AWS can sell higher value compute and services, then spending early can produce compounding advantages. Capacity leadership, better latency, better unit economics at scale, and the ability to say yes to the biggest customers when smaller rivals are constrained. What actually happened? Immediately, the stock fell about 10% in after-hours trading. That's the market's instant verdict. We're not sure the near-term payoff matches the near-term cost, especially with cloud growth slower than rivals. Opportunity cost, $200 billion is not just money, it's optionality converted into concrete. When you commit that much to CapEx, you are choosing to be less flexible in the face of changing demand curves, changing chip supply, and changing pricing dynamics. Hidden trade-offs? The hidden trade-off is that CapEx can become a defensive spend. You might not be spending to earn extraordinary returns. You might be spending to avoid falling behind. And defensive CapEx typically compresses returns on invested capital over time, even if revenue grows. Decision 2. Accept the industry-wide CapEx stack of $700 billion plus. What was expected? Collective investment should create the infrastructure needed for AI growth. In theory, more supply enables more products, more adoption, more usage, more revenue. What actually happens when everyone builds at once? The risk is commoditization at the infrastructure layer, more capacity chasing similar workloads, unless differentiated services capture the margin pool. The article doesn't give us the full unit economics here, but it gives us the key symptom: investor angst. That's the market telling you it suspects returns will be competed away. Now, the visuals. This front page is packed with them, and your video will show them, so the narration has to match what's on screen. On screen, you see the market tape at the very top: Dow, Nasdaq, yields, oil, gold, currencies. This is a risk-off frame. The whole market is already nervous about growth. That matters because big CapEx announcements land differently in a nervous tape than in a euphoric tape. On screen, you also see a bar chart about annual credit card revenue for the biggest issuers: Citigroup, JP Morgan Chase, Capital One, and American Express, showing 22,004 and 22,005. The text below it says the biggest credit card issuers collected about $146 billion in revenue last year, and it calls it a money machine that could be at risk from a federal interest rate cap on credit cards. That's not directly Amazon, but it's part of the same macro story, where the money is and where regulation or policy could change the economics. It's a reminder that in every cycle, some profit pools look permanent, right until they become political. And the deeper truth is that this CapEx arms race is also a narrative arms race. Every company wants to be seen as leading AI, but markets are now splitting the winners from the spenders. Meta and Google are getting rewarded because their ad businesses are improving. Microsoft and Amazon are getting punished because the market wants clearer evidence that AI spending is converting into AI revenue fast enough. That's a brutal standard, but it's the standard of public markets. Now, 3 lessons to take away. Lesson 1. In a platform shift, CapEx becomes strategy. The balance sheet becomes a product. The ability to finance and deploy infrastructure at scale becomes the moat, until it becomes a burden. Lesson 2. Payback periods matter more when everyone is doing the same thing. If all the giants build data centers, the infrastructure layer can turn into a lower return utility and less differentiation moves up the stack. Lesson 3. Stocks price the gap between spending and proof. The gap is where volatility lives. The gap is where value investors either get paid for patience or get punished for believing too early. So what's the core question raised by this article? It's whether Amazon's $200 billion CapEx plan is a compounding investment or a compulsory tax to stay relevant in AI. And I'll end with one sentence you'll remember for years. In the AI era, the scarcest resource isn't chips, it's return on invested capital. Moving to next title, new data paint a gloomy labor picture. Openings fell by 386,000 in December to the lowest level since September 2020. That's the kind of number that doesn't shout, but it changes the weather. This is the Wall Street Journal, and the story is describing a labor market that is starting the year with a dull ache, sluggish job growth, employers reluctant to hire, and a rising willingness to cut payrolls. Not a collapse, not a crisis, something more insidious for investors, a slow tightening that changes behavior before it changes headlines. And when labor changes behavior, it changes everything. It changes consumption, it changes pricing power, it changes corporate margins, it changes the politics of the next cycle. So why does this moment matter? Because for the last few years, the labor market has been the shock absorber. Companies complained about costs, but they didn't fire quickly. They held on to people. They treated talent like a scarce input. Now the story is different. The article says we're getting more reports from government and private sources that point to sluggish job growth and employers' reluctance to hire. It's filling in a picture of a labor market that slowed considerably in 2025, as economists wait for the official January report. The central figure in this story isn't a politician. It isn't the Fed. It's the corporate employer, the real capital allocator in the labor market. Hiring is capital allocation. When a company hires, it's making a long-duration commitment. Salary, benefits, management bandwidth, onboarding, equity grants, culture cost, those are all investments. When a company stops hiring, it is choosing optionality. It's choosing to wait, and waiting is a form of tightening. Now look at the evidence the article gives. Revelio Labs estimates the U.S. lost 13,300 jobs in January. Challenger, Gray, and Christmas says companies announced 108,400 job cuts last month, up sharply from 35,500 the month prior. And it says that's the highest level for the month since 2009. That's a very specific kind of signal. Not just layoffs happening, but announcements accelerating. Announcements are the forward indicator, their management acknowledging reality publicly. Now, the inflection point. The story about why this is happening. The article says recent cuts and sluggish hiring relate largely to bloat. Many companies expanded their workforces during the pandemic, hiked pay, and worried that moving too slowly would leave them short of skilled workers. Now some companies say their hiring sprees went too far. This is the classic cycle. Fear of scarcity. Overhire. Then regret. Then the slow unwind. It's about internal correction, and then you get a clean data point from ADP. Private sector added only 22,000 jobs in January, less than half of what economists surveyed by the journal expected. The Economist quote is blunt. It's trudging along. Now, there's an interesting tension in the article that investors should pay attention to. Some economists are hopeful growth could pick up, spurred by tax cuts and investment incentives created by last summer's tax and spending megabill. But the latest data indicates such a turnaround has yet to begin. So you have future optimism competing with present data, and markets tend to pay the present bill first. Now let's talk about claims. The number of people claiming unemployment benefits rose to 231,000 last week, above the 212,000 economists expected. The article notes these numbers fluctuate and might have been boosted by heavy snowfall hitting construction and manufacturing, temporary cuts. But even with caveats, the direction matters. A rising claims number is a small crack in the low fire story. And then we get the phrase that, to me, defines the entire labor regime of this moment. Low hire, low fire. That is not a hot market. That is not a recession. That is stasis. In a low hire, low fire environment, the biggest damage isn't the jobs lost. It's the mobility lost. People stay stuck. Wage growth cools. Risk-taking declines. Consumer confidence erodes quietly. Now, the official jobs report. The government's January jobs report is scheduled for release on February 11th, slightly delayed by the recent partial government shutdown. Analysts surveyed by the journal expected to show 60,000 jobs added last month, up from 50,000 in December. But the article adds an important detail. That report will include an annual benchmark revision expected to significantly lower the final tally of jobs created between April 2024 and March 2025. So even if the monthly number looks okay, the revision could reframe the narrative. Maybe the economy was weaker than previously believed. And the article says that outside a recession, 22,005 had the lowest pace of average monthly job growth since 2003. That is not a throwaway line. That's a regime label. Now I want to do the capital allocation/decision autopsy, because this article is implicitly about corporate decision-making. Decision 1. Hiring aggressively during the pandemic. What was expected? That demand would remain strong, that talent would remain scarce, and that being late would be fatal. What actually happened? In many cases, payrolls got bloated. Hiring went too far. Companies now feel the need to correct. Opportunity cost. The opportunity cost of overhiring is that you later cut into the muscle to save the bone. You lose culture, you lose momentum, you damage trust, and you force managers to spend time on reduction instead of creation. Hidden trade-offs? When layoffs come, the people who remain tend to become more risk-averse. That can slow innovation for years, quietly. Decision 2. Freezing hiring rather than firing. What was expected? Preserve capability while reducing costs gradually. Avoid morale shock. Hold optionality. What actually happens? A low-hire environment makes job seekers miserable, slows wage growth, and makes it harder for companies to find new skills when they actually need them. Decision 3. The AI question. The article addresses it carefully. Economists have wondered when advances in AI will lead to wider cuts in white-collar workforces. It says that era might be approaching, but it has yet to forcefully arrive. That matters because investors keep trying to price AI as a near-term labor shock. The article is saying, not yet. The current cuts are more about bloat than bots. But not yet is not never. Now, let's handle the visuals because this page is built for on-screen evidence. On screen, you see a labor market dashboard titled U.S. Labor Market Monthly Data. It includes quits at 3.2 million, job openings at 6.5 million, layoffs at 1.8 million, hires at 5.3 million. You also see a chart of initial claims for unemployment, with the latest point showing 231,000 for the week ended January 31st. And you see a time series chart of job openings across years, with a call-out that job openings dropped 386,000 in December to the lowest level since September 2020. This is what I want the listener to picture. A cockpit. Multiple gauges, none of them flashing red like a stall warning, but enough drifting in the wrong direction that you start flying differently. Now the reality check. The labor market is weakening, but not breaking. And that's actually what makes it dangerous for markets. In a clean recession, policymakers respond fast, companies cut fast, and you eventually get a reset. In a slow grind, you get multiple quarters of disappointing data, cautious executives, and a market that keeps repricing growth down, not once, but repeatedly. The article also notes that job cuts were driven by losses in public administration, leisure and hospitality, and retail, while education and health, and financial activities and information continued to grow. So this is not uniform weakness, it's a rotation. Now, 3 lessons for investors. Lesson 1. Labor is the lagging indicator that becomes the leading indicator. By the time labor looks bad, demand has already turned. But when labor starts to soften, it changes consumer behavior and corporate guidance before GDP prints catch up. Lesson 2. Most layoffs aren't about forecasts. They're about regrets. The article's bloat explanation is crucial. Companies aren't cutting because they see the future clearly. They're cutting because the past was misallocated. Lesson 3. AI's impact will arrive through budgets first. Even if AI hasn't forcefully cut white-collar jobs yet, the fear in the experimentation can still reshape hiring plans, training budgets, and headcount approvals. The first-order effect is decision paralysis. The second-order effect is fewer jobs. So what's the core question raised by this page? It's whether the U.S. labor market is entering a period of slow deterioration that keeps growth and risk assets under pressure, or whether it stabilizes as policy incentives kick in. And I'll end with one sentence you'll remember for years. A weak labor market doesn't start with layoffs. It starts with companies deciding that waiting is safer than hiring. Moving to next title, DOJ to curtail appeals of deportations. 10 days to appeal, 15 days until automatic dismissal, unless a majority of judges vote to hear it. That's the policy. And that's the world. This is the Wall Street Journal, and the story is about the Trump administration attempting to eliminate most opportunities for immigrants with deportation orders to appeal their cases. An effort designed to strip due process rights so deportations can happen faster. I want to approach this like an investor, because investors are students of systems. We study incentives, we study bottlenecks, we study who gets to set the rules and who has to live inside them. And in this story, the rule is the product. The output is speed. The cost is procedural protection. That's the trade. Now, why does this moment matter? Because when government changes process, it changes outcomes at scale. A company changes a workflow and it affects margins. A government changes a workflow and it affects liberty, family structure, labor supply, and the credibility of institutions. And it's rarely framed that way in daily news. It's framed as policy, but it behaves like capital allocation. You're allocating time, attention, and the right to be heard. Let's identify the central figures. The first central figure is the executive branch, specifically the Justice Department leadership, because immigration courts aren't structured like most courts in the U.S. The article says immigration courts are directly controlled by the political leadership of the Justice Department, which can set policies around how judges rule and even overturn decisions officials don't like. That matters, because it tells you who the board of directors is for the system. The second central figure is the immigrant with a deportation order, often a person seeking asylum. Because they're the ultimate price taker here. They don't set the deadlines, they don't select the forum, they don't choose the staffing levels, they don't choose detention policy, they react. And reaction time is the new choke point. Now, the inflection point. The administration is moving from procedure to throughput. The article says the new policy is posted to the Federal Register. It changes several rules to make it nearly impossible for immigrants to appeal their deportation cases. The big mechanical changes are simple and brutal. Immigrants get 10 days to appeal a deportation order. Instead of 30, appeals are automatically dismissed after 15 days, unless a majority of immigration appeals judges, handpicked by the Trump administration, vote to hear them. The changes take effect in a month. They were issued as an interim final rule. The public can comment, but feedback won't necessarily be consulted to reshape the policy further. That last part is important, because it tells you how the system is being managed. It's not a slow consensus process. It's a push. Now, let's do the decision autopsy like we would with any large organization attempting a turnaround. Decision 1. Compress the appeal timeline. What was expected? The administration says it will help clear an appeals backlog of more than 200,000 immigration cases. It also argues that reviews of immigration judges' decisions are often unnecessary because the appeals body isn't likely to disagree with the judge's reasoning. So the expectation is fewer appeals, faster deportations, less backlog, less administrative drag. What actually happens when you compress time that hard? You change what kinds of people can even participate in the system. People with money, connections, and fast legal access can react. People without those things can't. The article includes a key operational reality. Immigration lawyers say the new limits may not give immigrants enough time to find legal representation to file their appeal. Opportunity cost? The opportunity cost of speed is accuracy. Not because judges are bad, but because compressed timelines reduce the quality of representation, the completeness of evidence, and the chance to catch errors. And in most complex systems, legal, medical, engineering, error rates rise when you force throughput without building capacity. Decision 2. Create automatic dismissal as the default. This is the quiet genius. If your goal is throughput, you don't have to deny everyone. You just set the system so that the default outcome is dismissal unless the institution affirmatively intervenes. That flips the burden. The immigrant is now operating under a ticking clock, and the institution is operating under a presumption of no review. Hidden trade-off? When you make the default harsh, you can create second-order behavior. People abandon the legal process. The article says the government is also jailing more people for the duration of their deportation cases, leading immigrants to abandon the legal process. Detention isn't just a policy tool, it's an incentive tool. It changes the payoff matrix. Now, the political framing. Immigrant advocates call the changes an illegal attempt to strip immigrants of due process rights. The article quotes Charles Cuck, an immigration lawyer and advocate in Atlanta, saying it's a clear violation of the Due Process Clause and further evidence of the administration's disregard for the Constitution. And then the administration's argument is the classic efficiency argument. There is a backlog, and appeals are often unnecessary. This is the oldest conflict in institutional design. Legitimacy versus speed. Fairness versus volume. Individual rights versus system capacity. Now let's talk about the visuals the viewer will see on screen, because this page contains evidence in images and layout. On screen, you see a photograph of immigration officers apprehending a migrant during a targeted detainment at a U.S. immigration court in New York City. That image is not a statistic. It's a reminder that administrative changes end in physical outcomes. People moved, people detained, people removed. And on screen, you see the article's structure. The rule, the deadlines, the justification, the critique. It reads like an operations memo disguised as a legal notice. Now the reality check, what most people miss. Most debates about immigration focus on ideology, but systems are moved by process. And process changes can be more powerful than headline-grabbing laws because they don't require the same kind of legislative fight. They change the game by changing the clock. The article also points out a structural fact that's easy to ignore. Immigration courts are controlled by the Justice Department's political leadership. That makes them uniquely sensitive to administrative direction. Now, 3 lessons that translate beyond immigration into business, investing, and the way we evaluate systems. Lesson 1. If you want a different outcome, change the default. And defaults are destiny in high-volume systems. Lesson 2. Backlog is often a capacity problem disguised as a discipline problem. Clearing 200,000 cases by shrinking appeal windows is a throughput tactic. Another approach would be capacity expansion or process redesign that preserves review while increasing speed. The article doesn't say that's happening here. Lesson 3. Incentives shape participation. If detention increases and timelines shrink, more people abandon the process. That may be the intended effect or an accepted side effect. But either way, it changes the statistics that later get cited as proof that appeals were unnecessary. So, what's the core question raised by this article? It's whether a system that prioritizes speed over due process can remain legitimate, especially when the people affected have limited resources and limited time to respond. And I'll end with one sentence you'll remember for years. When a government shortens the clock, it isn't just speeding up the process, it's choosing who gets to be heard. Moving to next title, people get clingy with chatbots. That's the frame. This is the Wall Street Journal, and the story is not really about technology. It's about behavior. It's about how a tool slips quietly into the role of a companion, a coach, a referee, a neutral third party, a co-parent, a therapist, a creative partner, a business analyst. And once it's in that role, it stops being software. It becomes infrastructure for decision-making. That's why this matters. Because the biggest changes in history don't announce themselves as revolutions. They arrive as convenience. They arrive as small outsourcing decisions. They arrive as just this once helped me think. And then one day you look up and you realize you've been compounding dependence. The article opens with a person, not a product. Erica Atchison, going through a divorce, uses Anthropic's Claude to build a bot that generates images based on prompts from her and her friends. It starts as a hobby, a distraction, something harmless. Then she promotes Claude to an advisory position in her personal life. And that's the pivot. A hobby becomes counsel. A tool becomes voice. And soon her kids think she might need a break from her new friend. This is the central pattern. The super user doesn't just use the tool, they reorganize their life around it. And the people around them, friends, family, start to feel the gravitational pull, not because they hate AI, because they can sense something intimate being outsourced. Now, the central figures. The first central figure is the super user, the person who contracts out their work to groups of agents, amps productivity, and drops advice from ChatGPT. Chat as if it's their most trusted consigliere. Business strategy, social advice, even whether a friend should get a perm. The second central figure is the skeptical spouse, the skeptical kid, the skeptical colleague, the person who still believes there's dignity in keeping some tasks human. And the third central figure is the chatbot itself, not as a sentient being, but as a behavioral magnet. It is the most available person in your life. It never gets tired, it never judges you, it never asks you to reciprocate, it will always respond. If you understand incentives, you understand why this spreads. Now, the inflection point, from tool to relationship. Atchison says Claude helped her navigate a relationship she suspected wasn't going anywhere. When she was later tempted to rekindle contact, she checked in with Claude. Stick to your guns, it told her. That's not image generation. That's judgment. And once you outsource judgment, you start to change who you are. Because identity is the sum of repeated decisions. The story gives you other lives inside this pattern. Eric Davich, a startup founder in Brooklyn, uses AI for recipe planning, workouts, business strategy, and vibe coding with his son. He uploads recordings of his executive coach meetings to ChatGPT to analyze his progress. Under stress, he asks ChatGPT what he did today and how he felt about it. And it responds like a trained reflector. Don't get caught off guard. Remember the progress you're making. That's powerful. It's also a form of dependency. You are building a self that is partially co-authored by a model's reflection of you. His wife, Julie Davich, a freelance journalist, is reluctant to use AI for writing. She doesn't believe it can replicate her 20 years of professional experience. And then comes the friction that every household will recognize. She asks him to write an important email to their son's school. She reads it. Something seems off. It's the same paragraph repeated 3 times. She asks if ChatGPT did it. He admits it. She rewrites the email. That's a small domestic moment. But it's not trivial, because it shows the new line we're drawing. AI for utility is tolerated. AI for voice is contested. Then utility wins again. Julie spends 3 days building her own website. Eric has ChatGPT's Atlas browser ingest her work and write instructions for another tool, Google AI Studio, to redesign it in less than 15 minutes. She plans to use it. Notice what happened there. Her identity as a writer and professional made her skeptical, but her identity as a builder with limited time made her pragmatic. Utility wins. Now you get the older generation's adoption curve, which is always the real tell. Michael Caruso, retired financial services professional, recognizes his 29-year-old daughter, Anna Caruso Sicenzia, is an AI superuser. He worries about inauthenticity, people getting called out for using something that looks fake like on LinkedIn. Then his daughter impresses him by showcasing capabilities, reports dissecting a southern Italian dialect spoken by his grandmother, and later help with his gardening hobby, hot pepper husbandry. And now he brags that his daughter has a high-powered direct report assisting her at work. He becomes a ChatGPT user himself. She has cut the umbilical cord. That's a beautiful line, because it describes the transfer of confidence from child to parent through an external tool. The tool becomes the shared interface. Now Anna's life. Let's ask Chat. ChatGPT talks her through fixing a faucet. It generates advice for a loved one navigating a challenging roommate situation. It helps vendor prioritization for her jewelry side business. And it starts to weigh in on friend group matters. And then the moment that makes you laugh and worry at the same time. A male friend asks whether he should get a perm. She has ChatGPT generate a photo. It comes back and they say no. He looks like Bob Ross.mi. This is where the story reveals something important. These models are becoming the new mirror. Not a literal mirror, a social mirror, a reputational mirror, a fast simulation of consequences. Now, I want to treat this like capital allocation, because that's the lens that matters most for long-term compounding. What is being allocated here? Attention, trust, and the right to be the final decision maker in your own life. Every time you ask the chatbot, you're doing a tiny trade. You give up a little friction, a little uncertainty, a little loneliness. In exchange, you get speed, structure, and a sense of being guided. That trade compounds. It compounds because you form a habit. It compounds because the model develops a general knowledge about you, as Davidge says, and becomes a better sounding board. It compounds because it's always there. And it compounds because your brain starts to treat the response like an externalized conscience. Now, the on-screen visuals, this page is heavy with them, and the narration needs to match what the viewer sees. On screen, you see an AI-generated image created by Erica Atchison's bot, meant to console a friend after a bear's loss. That image is a symbol: AI as comfort, AI as social glue, AI as emotional labor. On screen, you also see photos and graphics from a completely different story continued on the same page: a soybean farm, a semiconductor plant, solar panels, and a chart titled China's Share of U.S. Imports, with a line trending down to around 7.5% by late 2000. That juxtaposition is not accidental, even if it's just page layout, because it shows you two kinds of decoupling happening at the same time. Nations are decoupling supply chains. People are decoupling parts of their inner life from other humans and coupling it to a machine. Both are about sovereignty. Both are about dependence. Both are about what happens when trust shifts. Now, reality check. AI hasn't been beneficial for every relationship. The kids complain. The spouse gets annoyed. People worry about authenticity. People worry about being replaced in the emotional stack of someone they love. And accuracy still fails in silly ways. One kid says ChatGPT couldn't correctly identify a Pokemon. Another time it generated an image of him with one leg, then 3 legs. So the tool is not perfect, but that's not the point. The point is that imperfect tools can still become emotionally central if they are useful and available. Now, 3 lessons, timeless ones for investors and builders. Lesson 1. The most powerful products aren't adopted, they're installed. They become defaults. They become verbs. Let's Ask Chat is a behavioral install. Lesson 2. The new moat is not data, it's habit plus trust. The model that becomes your sounding board is harder to replace than a normal app because switching costs become psychological. Lesson 3. The biggest risk isn't that AI lies. It's that AI becomes the place you go before you go to people. That's a quiet reordering of relationships. So what is the core question raised by this story? It's whether outsourcing thought, emotion, and judgment to a chatbot makes us more capable, or just more dependent. And I'll end with one sentence you'll remember for years. The moment a tool becomes your confidant, it stops being a feature, and it becomes a power. Moving to next title, government won't help the AI job transition. A consensus has formed that AI will require massive new government programs, and the authors are saying that consensus is dangerously wrong. This is the Wall Street Journal opinion page, and the piece is titled, "Government Won't Help the AI Job Transition." It's written by Phil Graham and Michael Solon, and it's an argument about incentives, not empathy, about transitions, not promises, about what actually happens when you pay people to wait. I want to treat this like we treat any investment thesis. What is the claim? What is the evidence? Where are the hidden trade-offs? And what happens when the incentives compound over time? Because that's what government programs do. They compound. They don't just spend money, they change behavior. The core idea of the piece is Schumpeter's wave of creative destruction. That's the engine of living standards. Old jobs and unprofitable investments get cleared out. Labor and capital get freed up, and they get redeployed into higher-valued goods and services. The more seamless the transition, the greater the gain. And then, the authors make the patriotic claim that matters to their whole argument. American exceptionalism is partly about creating new technology and being first to implement it, but also about moving labor and capital efficiently into higher and better uses. So far, fine. That's a theory of compounding at a national level. Then they put numbers on it. On average, every month since 2000, about 5.1 million American workers were separated from their jobs or laid off, and more than 5.2 million new jobs were created. In 2000-2005, they say 3 times as many Americans changed jobs as workers in the European Union. This is them describing a system that churns, a system that reallocates, a system that doesn't treat a job as a permanent entitlement, but as a temporary contract in a dynamic economy. Then they contrast China. They argue China is inefficient at dealing with creative destruction, and that most industrial subsidies there are used to sustain non-competitive businesses. Their conclusion is blunt. The U.S. channels creative destruction more efficiently than any other country, and Americans are constantly enriched by it. Now comes the turn. The part that makes this controversial. They say government programs have provided a cushion to displaced workers, but they've also impeded transitions. That's the whole piece. The cushion becomes a friction. The bridge becomes a waiting room. And then they do what I respect. They name specific programs and cite outcomes. First, Trade Adjustment Assistance, started in 1962. It provided training, job search help, and income support to workers harmed by foreign trade. It has provided benefits to more than 5 million people. Then they say numerous studies highlighted TAA's failure by comparing TAA beneficiaries to workers who lost jobs in the same period but didn't receive TAA. They cite studies by the Government Accountability Office, the Labor Department, and the U.S. International Trade Commission, saying TAA was insufficient in supporting workers to re-enter the labor market. It didn't improve earnings. Benefits were used mostly as income support, and non-participants were re-employed faster than participants. That last line is the knife. A program designed to speed re-employment may have slowed it. Now the second example, unemployment insurance. Adopted in the 1935 Social Security Act, expanded over decades. They cite a classic 1988 study by Lawrence Katz and Bruce Meyer. For every week of extra benefits, the covered worker was unemployed for as much as an extra day. Then they cite the Congressional Budget Office. Many workers find jobs in the weeks immediately before and after benefits run out. Again, the incentive mechanism is the point. The system sets a timer, and behavior clusters around the timer. So their conclusion is, unemployment benefits are valued, but the longer they are provided, the longer the worker will remain unemployed on average. Now they widen the lens to the war on poverty, about 60 years old in their framing. They quote Lyndon B. Johnson saying it wasn't a struggle simply to support people, but to allow them to develop and use their capacities. Then they give the number meant to make you sit up, as annual federal welfare spending surged to more than $70,000 per poverty family. Labor force participation among able-bodied persons in the lowest income quintile collapsed to 36%, from 68% in 1967. That's the author's warning shot. They're arguing that the well-intentioned expansion of programs in response to AI displacement could idle tens of millions of workers, squander much of the economic benefit we hope to derive from AI, and foster what they call a bread and circuses political system, where those outside the labor force demand a growing share of benefits created by those who work. If you're listening as a value investor, you should recognize the structure of this argument. This is a return on investment argument. It's saying, if you subsidize non-participation, you shrink the productive base, and you increase the claims on the productive base. That's a bad compounding equation. Now, the piece isn't only negative. It makes a proposal, and the proposal is interesting because it uses AI as the solution to an AI-driven transition. They say a great blessing of AI is that it holds out the promise of facilitating transitions from old jobs to new jobs. AI has been used in individual job searches. Harvard Business School has used it to facilitate job placement for its graduates, but government hasn't applied it to assist the unemployed or current welfare recipients. Then the concrete idea, a national AI employment system. They describe it like an operating system for labor allocation, assess aptitudes and interests, match people with emerging jobs, provide individual training, track job openings in real time. And then the key condition that shows you their ideology in one line. Combine it with a mandatory work requirement. They claim that AI could provide the most effective worker transition in history and could revolutionize welfare by testing aptitude, providing training, and matching able-bodied welfare recipients with available jobs. So what's the central figure here? It's not AI, it's not government, it's incentives, because this piece is really about who gets paid to move and who gets paid to wait. And that brings us to the inflection point. AI is triggering fear. Fear triggers policy reflex. Policy reflex expands safety nets. Expanded safety nets can become long-term behavior-shaping systems that reduce mobility and participation. In other words, the attempt to cushion the wave can dam the river. Now, the on-screen visuals the viewer will see, because the article page itself matters in your format. On screen, the headline, "Government Won't Help the AI Job Transition," sits like a provocation. Under it, the page contains dense columns of text. This isn't a flashy, chart-driven argument. It's a claim-heavy, evidence-referencing argument. The point is to feel like you're reading an institutional brief, not a viral post. And the most important visual is actually numeric. 5.1 million separated per month, 5.2 million created, 5 million TAA beneficiaries, $70,000 per poverty family, participation collapsing to 36% from 68%. Those numbers are the scaffolding of their persuasion. Now, the reality check. Even if you disagree with the author's politics, their framework is the correct framework for any transition policy. Incentives dominate intentions. If you want people to transition, you have to reward movement. If you reward stasis, you will get stasis. And the unpleasant part is that stasis isn't neutral. It decays skills. It decays confidence. It makes future re-entry harder. There's also a second uncomfortable truth baked into their proposal. A national AI employment system would be a massive system of classification and matching. It would require data, measurement, and enforcement. And it would be paired, in their view, with a mandatory work requirement. That's not a small tweak. That's a redesign of the social contract. Now, 3 lessons I take from this. Lessons that apply whether you're running a country, a company, or a portfolio. Lesson 1. Transitions are the real bottleneck. In investing, returns come from moving capital from declining uses to rising uses. In economies, living standards come from moving labor and capital from old industries to new industries. If you freeze the transition, you freeze growth. Lesson 2. Subsidy design is destiny. Trade adjustment assistance and unemployment insurance are used in this piece as examples that benefits can become delays. The detail that non-participants were re-employed faster is exactly the kind of second-order effect that policymakers and investors ignore until it's too late. Lesson 3. Use AI to make the matching problem cheaper, not to make the waiting problem easier. If AI is a productivity tool, the highest leverage public use might be reducing the friction of re-employment. Aptitude assessment, targeted training, real-time openings, and accountability. Now, the core question raised by this opinion piece is simple and brutal. When AI disrupts jobs, do we build a bigger safety net that pays for waiting, or do we build a smarter transition system that pays for movement? And I'll end with one sentence I want you to remember for years. In every labor shock, the future belongs to the systems that reward motion, not the ones that subsidize pause. Moving to next title, Barrick plans to publicly list unit with North American gold assets. Barrick is taking the asset that produces most of its gold and putting it on a separate scoreboard, public markets, because the current scoreboard isn't giving it enough credit. That's the move. That's the tell. This is from the Wall Street Journal, and it's a case study in capital allocation disguised as a mining story. Because the commodity here isn't just gold. The commodity is attention. The commodity is valuation. The commodity is credibility. Barrick Mining plans to spin off its North American gold assets into a new publicly listed company, with management aiming to pursue an IPO by the end of the year. The article frames it as a reset after Barrick parted ways with its former boss Mark Bristow last year, and after a period where the company's valuation has lagged peers even as gold prices surged. And if you're a value investor, you know exactly what that means. It means the market is punishing complexity. It means the market is applying a discount to sprawl. It means the market is saying, show me the clean unit economics. Now, who's the central figure in this story? It isn't the ore body, it's the allocator. Mark Hill, a Barrick veteran who had been running the company after Bristow left, has been appointed chief executive and president permanently, and he's tasked with leading this IPO process. That matters because this is not a geology decision, it's a structure decision. This is a decision about what kind of company Barrick wants to be, and what kind of shareholder base it wants to attract. The article makes it explicit. Barrick plans to retain a significant controlling interest in the North American gold assets even as it lists the unit publicly. In other words, Barrick wants the valuation uplift without fully giving up control. That is the classic compromise of an incumbent. Unlock value, but keep the steering wheel. And here's the operational anchor, the hard number that explains why this is such a high-stakes move. Barrick's North American gold assets accounted for a little more than 60% of the 3.26 million troy ounces it produced last year. So we are not talking about a side project. We're talking about the core engine. Now let's talk about the inflection point. What quietly stopped working? The article says Barrick's shares rose sharply over the past year as prices for gold and other metals jumped, but analysts say Barrick's valuation has lagged behind peers. That's the key tension. The product is strong, the multiple is weak. When that happens, management eventually has to choose between two paths: wait and hope sentiment changes, or change the structure so sentiment has to change. Then there's the activist pressure. The article says Elliott Management has built a shareholding in Barrick and pushed for a breakup of the North American business from riskier assets elsewhere. Activists are basically auditors of incentives. They show up when the discount is persistent and management hasn't closed it. They don't need to be right about everything. They just need to be right that the current structure is leaking value. So Barrick's board gives management the go-ahead to pursue this IPO, and Hill hints at the shape of the deal. He indicates an IPO would likely include a 10 to 15% share of Barrick's interest in the assets, describing it as a multi-month process. That small range is a philosophy. It says, we want price discovery, not separation. Now I want to do the decision autopsy, because this is where the compounding lives. Decision: public listing of a unit holding North American gold assets. What was expected? A valuation uplift. Explicitly, the article says the aim is to boost value at a time gold prices have soared. What actually happened prior to this decision? Barrick experienced share appreciation with the commodity tape, but still lagged peers on valuation, and activist pressure built. Opportunity cost? If you keep the conglomerate structure, you keep paying a discount tax every day in public markets. And that discount tax compounds because it raises your cost of capital, it makes acquisitions harder, it limits strategic flexibility, and it turns every capital decision into a credibility fight. Hidden trade-offs? Once you list a unit, you invite a second set of shareholders, a second governance dynamic, and a second set of disclosure constraints. You also put the quality of that asset base under a microscope, quarter after quarter, with a price that moves independently of the parent. That can sharpen accountability, or it can create new internal politics. Now, the structure of what goes into the new company is the real story. The article says the new floated company will house Nevada Gold Mining, Barrick's wholly owned 4 Mile discovery in Nevada, and the Pueblo Viejo mine in the Dominican Republic. And then the joint venture nod appears. Newmont has a 38.5% interest in the Nevada operation and a 40% stake in Pueblo Viejo. This is where outsiders often miss the point. A spin-off isn't just asset A goes into box A. It's contract law. It's preferential rights. It's disclosure requirements. The article notes Nevada is covered by a venture agreement that includes disclosure requirements and preferential purchase rights. So the spin-off is also a negotiation with your partners, not only with your shareholders. And it raises the big unanswered questions the article flags. Who leads the new company, where it's headquartered, and what it means for Newmont's stakes and rights. Now let's go from structure to returns, because this is where management tries to buy back trust. The article says the jump in gold and copper prices buoyed Barrick's cash flows, lifted earnings in the latest quarter, and prompted the board to boost shareholder returns, including plans to increase the dividend 40%. It also notes Barrick had raised the base dividend 25% in November, and now says it will pay a quarterly dividend of 42 cents a share, more than double the 17.5 cents paid the quarter before, which included a performance dividend. But the most important part isn't the dividend size, it's the dividend philosophy. From the fourth quarter, Barrick says its policy will be to target a total payout of 50% of attributable free cash flow on an annualized basis. That payout will be structured as a fixed base quarterly payout of 17.5 cents a share, plus a performance top-up at the end of each year based on cash flow. That's a governance mechanism. It tells investors, we will not hoard cash just because we can. It also tells management, if you want to build an empire, you'll have to justify it in the face of a formula. Formulas can be crude, but they're powerful, because they reduce the wiggle room where bad incentives hide. Now the earnings power. This is the evidence management uses to make the whole story plausible. The article says Barrick's fourth quarter net earnings climbed to $2.41 billion, or $1.43 a share, from $996 million, or 57 cents a year earlier. On an adjusted basis, earnings more than doubled to $1.04 a share, beating the 90 cents forecast from analysts polled by FactSet. Revenue jumped 64% to $6 billion, topping the $5.2 billion expected by analysts. Those numbers are doing a job in this narrative. They are telling the market, this isn't financial engineering on top of weakness. This is structure on top of strength. But then the article forces you to look at the other side of the ledger. Risk. Barrick spans 17 countries and 5 continents, and the company has struggled in some parts of the world. Shortly after Hill became interim CEO, Barrick settled a dispute with Mali's military government to regain control of assets and secure the release of 4 detained employees, and the temporary closure in Mali ate into gold output last year. Barrick also launched a review of Reko Diq in Pakistan's Balochistan province, one of the world's largest undeveloped copper and gold projects, after an increase in security risks on the ground. This is the deep reason a clean North America gold unit is attractive to public markets, because investors don't just discount complexity, they discount tail risk, they discount sovereign risk, they discount headlines you can't model. Now, the forward-looking production guidance in the article gives you the intended compounding path. After selling assets including its last producing mine in Canada last year, Barrick expects to produce 2.9 million to 3.25 million ounces of gold this year, as much as 3.65 million ounces in 2027, and up to 3.75 million ounces the following year. Copper output is projected between 190,000 and 220,000 metric tons this year, after rising 13% in 2025 to 220,000. So you can see the corporate identity they're trying to shape, a gold base with a copper growth option. But that identity only works if markets trust the governance and the structure. Now I want you to picture what the viewer is seeing, because the visuals on the page are part of the persuasion. On screen, you're looking at a photo accompanying the Barrick story, an image tied to the company's North American gold operations. And the headline is doing what headlines do in investing. It compresses motive into one sentence. Barrick plans to publicly list a unit with North American gold assets. The visual and the headline together create a simple mental model. This is the good stuff, separated from the messy stuff. Now, the reality check. What I think a serious value investor should confront here. A partial spin-off can be an elegant move, but it can also be a half measure that satisfies nobody if execution is weak. If the parent keeps control, you still have related party questions, still have capital allocation tensions, still have the possibility that cash flows get pulled back into the parent's broader agenda. And if the new entity inherits too much complexity, joint ventures, preferential rights, governance constraints, you might not get the clean multiple you're reaching for. But I'll also say this, the fact that Hill is willing to put the crown jewel into a market price structure is a form of accountability. It's management saying, price us every day. That's uncomfortable. It's also often necessary right before a real compounding phase begins. So what are the lessons, timeless, portable lessons for investors and operators? First, valuation is a strategy constraint. If the market assigns you a persistent discount, your cost of capital rises and your future choices narrow, even if operations are strong. Second, spin-offs are incentive tools. They change what gets measured, who gets rewarded, and how capital flows, sometimes more effectively than any speech a CEO can give. Third, the best time to simplify is when you still have leverage. Barrick is doing this while earnings and cash flows are strong and while shareholder returns are being increased, not while it's pleading for patience. That timing is part of the message. And now the core question the article raises, the one you should keep in your head if you ever own a complex global business, whether in a portfolio or as an operator: can you earn a premium multiple while carrying a portfolio of unpriceable risks? Or do you need to separate the clean cash flows so they can finally compound without a discount tax? I'll end with one sentence I want you to remember for years. When a company chooses to list its best assets separately, it's admitting that the real bottleneck wasn't the mine, it was the market's willingness to trust the structure. Moving to next title, Germany finds Amazon overpricing tool. The most valuable currency in a marketplace isn't money, it's visibility. And once you understand that, you understand why regulators keep coming back to the same question. With Amazon, are you running a neutral platform, or are you steering the entire economy of your platform with invisible levers? This is the Wall Street Journal, and the story is about German antitrust officials finding Amazon over a pricing tool that filters out or downgrades third-party listings based on price. I want to think about this like a long-term owner, not like a headline reader, because this isn't really a $69 million fine story. This is a governance story, a system design story, a power story. Here's the fact pattern. Germany's Federal Cartel Office fined Amazon about 59 million euros, roughly $69.7 million, saying the tools Amazon uses to filter out listings from third-party vendors based on pricing breach competition law. And the regulator's core claim is simple. If Amazon restricts visibility or removes offers because of pricing, sellers can suffer significant sales losses. Now pause on that, because it tells you what the regulator is really saying. In a digital marketplace, being legal isn't enough. You also need to be discoverable. And Amazon controls discoverability. So the central figure here isn't a founder or a politician or even a product manager. The central figure is the marketplace operator as rulemaker, the builder who becomes the allocator who becomes the constraint. Amazon's marketplace is not a simple shelf, it's an algorithmic bureaucracy. It decides what shows up. It decides what doesn't, and it decides that at machine speed, with rules most sellers don't fully see. Now let's look at the mechanism, because the mechanism is always where the truth lives. The Federal Cartel Office says Amazon's tools effectively allow the company to influence prices set by competing vendors, including through price caps, and it ordered Amazon to stop using its tools in most cases. German officials said Amazon could still intervene in exceptional circumstances when prices are too high. So it's not never intervene, it's you don't get to run continuous price discipline across an entire ecosystem just because you own the storefront. And Amazon's description of the tool is also revealing. Amazon says its pricing mechanism evaluates competing offers from multiple sellers and highlights those customers are most likely to choose based on pricing and other factors, giving them more visibility. And when Amazon's systems detect prices that are unusually high, listings can be downgraded or removed altogether so they don't feature prominently. This is the key. It's not only about price. It's about featuring. And featuring is allocation. It is the allocation of demand. It is the allocation of conversion probability. It is, functionally, the allocation of revenue. Now, here comes the inflection point in the story. Germany isn't attacking Amazon's desire to offer low prices to consumers. At least that's explicitly what the regulator says. The FCO president, Andreas Mundt, says officials aren't taking action against the goal of offering the lowest prices, but that pricing mechanisms weren't needed to achieve this. And he adds the line that crystallizes Germany's position. Amazon is not allowed to restrict visibility of legally permissible offers, or remove them simply because prices aren't in line with Amazon's expectations. That phrase, in line with its expectations, is doing a lot of work, because it's not describing an objective standard like fraud or safety or counterfeit detection. It's describing a private company's internal sense of what prices should be. And if you're a value investor, you should immediately recognize the business quality question underneath. Amazon's marketplace strength comes from trust. Customers trust they won't be ripped off, sellers trust they can compete, and both sides trust the rules won't change arbitrarily. When a regulator steps in, it's often because that trust has tilted too far toward one side, the operator. Now the capital allocation autopsy. This is where I slow down because this is where the compounding happens. Decision. Amazon enforces a pricing-based visibility filter. What was expected? More customer trust, fewer overpriced offers, and a cleaner shopping experience that increases conversion, especially on price-sensitive items. What actually happened according to the regulator? The regulator argues that restricting visibility or removing seller listings because of pricing can lead to significant losses in sales for those sellers, and that Amazon's tools effectively influence prices set by competing vendors, including through price caps. Opportunity cost. What does Amazon give up by doing this in the first place? It gives up neutrality. And in platform businesses, neutrality isn't a moral concept. It's a strategic asset. If you're perceived as neutral, you can scale supply. If you're perceived as coercive, you may still scale supply, but regulators, lawsuits, and seller churn become the tax you pay. Hidden trade-off. The difference between ranking and punishment. Every marketplace ranks, but once ranking becomes a mechanism to enforce a preferred price band, you're no longer just helping customers find good deals, you're nudging the entire price formation process inside your market. And now Germany is basically saying that nudge crosses a legal line in many cases. There's also an important procedural detail in the story that tells you how this fight will drag on. The FCO says the decision isn't final and gives Amazon 1 month to appeal before the Federal Court of Justice steps in. Amazon, predictably, says it will appeal. Rocco Breuniger, Amazon Germany's country manager, calls it an unprecedented regulatory outcome, says Amazon will continue operating as usual to avoid disruption, and argues the decision is based on unique German regulations that conflict with competition law consumer standards in the European Union. He even frames it as a consumer harm. He says Amazon would be the only retailer in Germany forced to promote uncompetitive prices to customers because of the decision. Now I want to talk about the on-screen evidence, because your format depends on alignment between visuals and narration. On screen, you see the technology and media section styling and the headline, Germany finds Amazon over a pricing tool. You see the key number, about 59 million euros. And then you see a photograph, an Amazon employee delivering parcels in Berlin. That photo matters more than it seems. It's the symbol of Amazon's physical legitimacy, the real-world machine behind the digital shelf. And it reminds you that the marketplace isn't just pixels. It's logistics, delivery expectations, customer habits, and seller dependency. Now, the broader context in the article is a single sentence that explains why Germany feels entitled to act this way. Amazon has faced closer scrutiny in Germany since the regulator said in 2022 that Amazon was of paramount significance for cross-border competition, a designation that triggers expanded surveillance to prevent anti-competitive practices. So this is not random. This is the consequence of being designated systemically important inside a legal framework that treats size as risk. Now for the reality check. The uncomfortable truths. First uncomfortable truth. Consumers love low prices. But competition law isn't only about consumers today. It's about preventing one gatekeeper from setting the rules of price formation for everyone else. Second, uncomfortable truth. Sellers are independent only on paper if the platform can throttle their visibility based on private expectations. The regulator's language, visibility restriction leading to significant sales losses, makes clear that visibility is the economic lifeline. Third uncomfortable truth. Amazon's best defense is also its greatest vulnerability. Its defense is that the system improves customer experience by highlighting offers customers are likely to choose. Its vulnerability is that the same system can be interpreted as influencing competitors' prices, including via caps. So, what does this mean for investors who care about long-term compounding? It means the marketplace model is still extraordinary, but its regulatory maintenance capex is rising. Not maintenance capex in warehouses, maintenance capex in legal defenses, compliance redesign, and product constraints that limit how aggressively the platform can optimize for price. This is exactly how moats get more expensive. Not by collapsing, by demanding continuous reinvestment just to keep the same shape. Now, 3 lessons for operators and value investors. Lesson 1. In platforms, ranking equals power, and power becomes regulation. If your algorithm decides who gets demand, you will eventually be treated like a utility, even if you call yourself a retailer. Lesson 2. Incentives are policy, even when they look like UX. A downgrade is not a UI choice. It's an economic sanction inside your ecosystem. Lesson 3. The cleanest business models often create the messiest governance questions. Amazon's marketplace is efficient precisely because it's centralized. But centralization is what makes regulators nervous, because centralization can turn optimization into coercion. So here's the question I'm left with after reading this. Can a marketplace operator be both the judge of fair prices and the beneficiary of the market it governs, without eventually being forced to separate those roles? And I'll end with one sentence you'll remember for years. When a platform controls visibility, it controls the market, and eventually, the market demands a referee. Now, towards last article, Google leans hard into AI lead. If you've got it, spend it. That's the motto the article hands you for the artificial intelligence race. And once you hear it, you can't unhear it because it explains almost everything you're watching in big tech right now. This is the Wall Street Journal. The piece I'm focusing on is called Google Leans Hard into AI Lead. And it's not really an AI story. It's a capital allocation story. It's about a company that already prints cash, deciding to turn itself into a cash-to-compute conversion machine at a scale that almost doesn't exist anywhere else in capitalism. Because here's what's happening. Meta goes on its quarterly report and says it plans to spend up to $135 billion on capital expenditures this year. That's up from about $72 billion the year before. And then Google comes in and tops it. Google says it could spend as much as $185 billion this year, which would be about double its outlay from the year before. I want you to feel the size of that number. $185 billion is not a budget. It's a strategy. It's a declaration of what kind of company you want to be, and what kind of battlefield you're choosing to fight on. Now, why does this moment matter? Because every great business cycle has a phase where investors confuse enthusiasm with inevitability. And every great business cycle has a phase where the leaders start pouring capital into the future, not because they're desperate, but because they're strong. That's the dangerous part. When the incumbents are strong, they can afford to overbuild. They can afford to chase optionality. They can afford to make the whole industry more capital intensive. And the article is doing something subtle. It's saying, Google's ad and cloud growth acceleration justify the surge in Alphabet's stock. But the CapEx forecast takes your breath away. That but is the heart of the piece. So let's identify the central figure. In stories like this, people want a founder, a visionary, a single face. But the real central figure is the allocator. Google as an institution is acting as a builder and an allocator at the same time. It's building models. It's allocating capital into chips and infrastructure. And it's leveraging the rarest asset in tech, distribution. The article describes it directly. Google has both the political and financial capital to lay such a bet. Political capital, because the company just got a victory over the federal government's efforts to break it up. Financial capital, because it sits on a business model that throws off cash in a way that still doesn't make sense to most people, until they run the math. And then you get the product story, but it's delivered like a business story. The company's Gemini 3 model has put it on top of the heap of performance for AI models, and the unmatched distribution of search and products like Gmail has quickly driven adoption. Google says it has more than 750 million monthly active users on its Gemini app alone, and the article emphasizes that this is only a portion of Gemini's actual users. That's not a feature metric, that's a moat metric. Because in AI, performance matters. But distribution determines the slope of the adoption curve. And adoption determines what data you get, what workflows you become embedded in, and what defaults you become for billions of decisions. Now, the inflection point, the AI competition is shifting from being a software race to being an infrastructure race. In early hype cycles, we talk about cleverness, we talk about models, we talk about demos, we talk about the romance of invention. But eventually, the romance ends. And the bills begin. Then the whole game becomes, who can fund the compute, Who can build the data centers? Who can stomach the depreciation? And who can do it long enough for the economics to settle? And that's why, if you've got it, spend it is so important. Because the winners aren't just the ones with the best idea. They're the ones with the balance sheet and cash flow to keep spending through the ugly middle. Now let's do the decision autopsy. The decision. Google plans to spend up to $185 billion on capital expenditures this year. What was expected? A durable lead. Not just leadership in model benchmarks, but leadership in product adoption, enterprise relationships, and the infrastructure layer that underpins everything. What actually happened to the stock around the announcement? The article notes Alphabet slipped in after-hours trading after its fourth quarter report and conference call and ended down less than 1% the next day. That's a market response that says, we like the business. We're nervous about the bill. Now the opportunity cost. What else could you do with $185 billion? You could buy back stock at an enormous scale. You could make acquisitions. You could return cash. You could keep margins clean. You could protect near-term earnings optics. But Google is choosing the opposite. It is choosing to turn near-term optics into long-term positioning. And the hidden trade-off is depreciation. The article makes that explicit. These investments will sharply elevate depreciation charges, and in the latest quarter, depreciation reduced net income by 18%. That's not a rounding error, that's the cost of building the future early. Now we get to the question every value investor should ask. What is funding this? Because CapEx is easy to announce when you're in love with the future. It's harder to sustain when cash flow is weak. But Google's cash flow is not weak. It's the opposite. The article walks through the engine room. Advertising is still the cash cow. It is still managing double-digit growth rates. And that growth accelerated. Ad revenue was up 14% in the fourth quarter, compared with 13% in the previous one. Then cloud. The cloud division was even more impressive. Revenue jumped 48% year-over-year to $17.7 billion. The article notes Google Cloud hasn't seen growth like that since early 2021, when the business was less than a third of its current size. And then profitability, which is the part that changes the narrative. Google Cloud produced a record $5.3 billion in operating profit in the latest quarter, 45% higher than Wall Street's targets. And finally, the compounding fuel. Cash flow. The article says Google's booming businesses produced nearly $165 billion in operating cash flow in 2025, the highest in the S&P 500, using data from S&P Global Market Intelligence. That number matters because it reframes the CapEx. CapEx at this scale isn't simply spending. It's reinvestment of a massive internal yield. It's the company saying, we are going to recycle cash into compute faster than competitors can. Now, here's where the piece gets intellectually honest. It doesn't pretend this is risk-free. It says spending what could be 40% of annual revenue on AI chips and related infrastructure is a sizable gamble. 40%. That's the kind of number you usually see in heavy industry, not in software. So what's the market's job here? The market's job is to decide whether this is rational reinvestment or an arms race that destroys returns. And we should be clear, both are possible. Because when the leaders spend at scale, they can widen the moat, but they can also make the whole sector structurally less profitable by normalizing massive, continuous reinvestment. Now let's bring in valuation, because the article makes a point that should make long-term investors uncomfortable in a productive way. Google isn't the bargain it was less than a year ago when breakup fears had the stock trading at less than 16 times projected earnings. The article says that multiple has nearly doubled since. So you have a company that's re-rated upward, that's now committing to a huge CapEx step-up, and that's doing it as the market grows more worried about AI disrupting established tech players. And the article adds an important twist. It's not just that AI might disrupt other companies. It might disrupt cloud software providers that are major customers of Google, Microsoft, and Amazon. That's a subtle fragility. Because if AI compresses the value of certain software layers, the demand patterns inside cloud could shift. Some workloads might grow. Some might shrink. Some might be rebuilt internally by customers. So even if Google is clicking, well, the interconnected nature of that business means it can't exactly stand alone. That line is one of the most important lines on the page, because it's the difference between a great business and an invulnerable business. Great businesses still live inside ecosystems. Ecosystems change, and when the ecosystem changes, even the winners have to pay the adaptation tax. Now I want to make the listener see what's on screen, because the visuals on this page are evidence. On screen, you're looking at a chart comparing capital expenditures for Google and Meta across a timeline from 2020 through 2026. The chart shows the lines rising, but what jumps out is the projection for 2026, where Google's planned spending towers above prior years and above Meta's. There's a note that 2026 is the high end of company projections, which is a polite way of saying this is the ambitious scenario. What's being measured? Raw capital expenditures in billions of dollars. Why does it matter? Because CapEx is where strategy becomes irreversible. You can change a press release, you can't unbuild a data center overnight. What most people miss is that CapEx doesn't just buy hardware, it buys a time advantage. And in AI, time advantage becomes product advantage because models and workflows compound through usage. Now another visual. On screen, you see a share price performance chart over the past 3 months comparing Alphabet, Amazon, and Microsoft. Alphabet is up around 20% in that window, while the article notes several other big names lost ground. What's being measured? Price performance in percentage terms across a short window. Why does it matter? Because it shows how quickly sentiment can shift even among giants. And it tells you the market is rewarding perceived momentum in AI and in core business execution. But it also warns you, short windows can seduce you into thinking a narrative is permanent. They aren't. Now the third visual on the page is the one that drags this story into a longer cycle. It's a chart of the Nasdaq Composite's moves since the unveiling of Netscape and since the unveiling of ChatGPT, plotted by years since release. Netscape Navigator's release is positioned as the early consumer gateway to the internet era. ChatGPT's debut is positioned as the early consumer gateway to the AI era. This chart is telling you, we've seen a pattern like this before, and it's paired with a narrative on the page that asks the classic investing question, what inning are we in? The page mentions an investor survey where the median reply was the 4th inning, and only a tiny fraction said the 9th. Then it leans into the seductive idea of parallel timelines, Yahoo's explosive IPO, Greenspan's warning, a famous Amazon price target, and a hypothetical top in the index years from now. And then it does the responsible thing and says, investing by following lines on a graph is a terrible idea. That's important, because graphs can hypnotize. But valuation is what decides your long-term return. And the page underscores that with a statement about the S&P 500's valuation, using long-term measures like the Shiller P/E being up to late 1,999 levels. The reason I'm bringing this in is that it connects directly back to Google's CapEx plan. When valuations are rich, expectations are rich. When expectations are rich, companies feel pressure to justify the future. When companies feel pressure to justify the future, they spend. Spending can be rational. Spending can also be a symptom of the narrative needing fuel. So the reality check here is not Google is wrong. The reality check is, even if Google is right, the outcome for investors depends on the price you pay and the durability of returns on that incremental capital. Because capital allocation is judged in hindsight, but it's executed in fog. Now, what does this mean through a value investing lens? It means you have to stop thinking of Alphabet as a monolith and start thinking of it as a portfolio of compounding engines with a shared infrastructure bill. Engine 1 is advertising. It's still growing double digits. It's still throwing off cash. That cash is funding the AI build-out. Engine 2 is cloud. It's accelerating and, crucially, generating real operating profit at scale. $5.3 billion in the latest quarter, a record and far above expectations. Engine 3 is distribution. Search, Gmail, and the rest are not just products. They're rails. And rails are what let you push a new product like Gemini into the bloodstream of daily life fast. But then there's the bill, the infrastructure build-out, the chips, the data centers, the depreciation. And this is the tension. The engines compound. The bill compounds too. So your job as a long-term investor is to ask, does the incremental dollar of CapEx create a durable advantage that produces incremental free cash flow per share over time? Or does it simply keep you in the game while returns get competed away? And you don't answer that by cheering for the biggest number. You answer it by tracking the second-order effects. Does cloud profitability persist as AI changes software economics? Does ad growth continue as product surfaces change? Does Gemini adoption translate into revenue streams that have high gross margins, not just high usage? Does the company maintain pricing power in the face of rivals also spending aggressively? Because make no mistake, if Google is spending $185 billion, it's not because it wants to be polite, it's because it believes the prize is enormous. And the prize is not a better chatbot. The prize is being the default layer, where work gets done, where queries happen, where commerce flows, where decisions get outsourced. Now, let's talk about the psychological side, because the article hints at it. It says the strong reception of Gemini, along with Google's victory over breakup efforts, has cheered investors when sentiment on technology and AI is faltering. So you have a narrative shift from fear to relief, from they'll break you up to you're free to spend. That's a powerful combination. Regulatory pressure eases, product momentum rises, cash flow accelerates. And that's exactly when you see the most aggressive capital plans. Now, I'll bring it back to founders and operators, because that's where the timeless insight lives. Founders build an engine, operators scale it. Allocators decide what to do with the cash the engine throws off. Alphabet is now in allocator mode at a historic scale. It is making a bet that its best use of capital is to push into AI infrastructure with force. Not cautiously, not incrementally. With a doubling of spend. That tells you something about internal conviction. It also tells you something about internal fear. Because if you truly believed this was a small transition, you wouldn't spend like a wartime economy. You spend like this when you believe the slope of the curve matters, and you don't want to lose time. So here are 3 lessons I want to extract, and I want them to be useful even if you never buy a share of Alphabet. First lesson. The best businesses become the most aggressive reinvestors when they see a platform shift. They do it because they can, and because they know the cost of being late is usually higher than the cost of being early. Second lesson. Distribution is the quiet superpower that turns product capability into market reality. Gemini's performance matters, but 750 million monthly active users on the app is the kind of adoption number that comes from distribution leverage, not just model quality. Third lesson. The compounding of depreciation is the tax of building the future. A big CapEx step-up can depress near-term earnings not because the business is deteriorating, but because accounting is catching up to strategy. That doesn't make it good or bad automatically. It makes it a different kind of investment. This is not a steady compounder at any price. Story. This is a compounder choosing to become more cyclical through capital intensity story. Now I want to answer the core question the article raises. Does Google's surge in CapEx make sense? The article's answer is, the business momentum makes it digestible, but the size of the bet is still breathtaking and risky. My answer, as a value investor thinking out loud, is the bet makes strategic sense because AI is turning into an infrastructure game and Google has the cash flow, profitability, and distribution to play it. But the investment outcome will depend on whether returns on that capital remain high after competitors match the spending and after the ecosystem absorbs the disruption AI causes downstream. Because Google doesn't get to stand alone. Its customers are in the blast radius too. And I'll end with one sentence I think you'll remember for years. When a company starts spending like a utility to win a software war, the real question isn't whether it can afford the bill, it's whether it can still earn software returns on infrastructure capital. This is Avi. Like and subscribe. On to the next.